Here's a fact that sounds impossible. The stock market can go up for years straight, and most regular investors still manage to walk away poorer than the index they were buying. A rising market is supposed to be the easy mode of investing. Everything goes up, everyone's a genius, and yet somehow the crowd finds a way to snatch mediocrity from the jaws of a historic rally. Today I want to unpack exactly why that happens, because the reasons are painfully human, weirdly predictable, and once you see them, you genuinely can't unsee them in your own behavior. Quick disclaimer before we dive in. This is an educational and entertainment channel, not personalized financial advice. I'm here to explain patterns, not to tell you what to buy on Tuesday. First, let's define our terms. A bull market is generally a sustained period where asset prices rise, often marked by a rise of 20% or more from a recent low. During these stretches, optimism becomes the default mood. Headlines get cheerful, your coworkers start giving stock tips, and the whole environment quietly whispers that making money is simple and permanent. And that whisper is the trap. The market being up does not mean you are up. Your personal return depends entirely on what you bought, when you bought it, and how you behaved along the way. There's a measured gap between what markets return and what investors actually earn. Research firms have tracked this for decades, and the average investor consistently underperforms the very funds they own. So why does the gap exist? The number one culprit is timing, specifically the human urge to buy after something has already gone up a lot and to sell after it has already fallen. In a bull market, this urge goes into overdrive. You see an asset triple in a year, and instead of feeling cautious, your brain reads that chart as proof it's safe and about to triple again. That's performance chasing. You pour money in near the top, right when future expected returns are lowest and the price already reflects all the good news everyone is excited about. Let me ask you something directly. When was the last time you got excited about an investment because it had gone down? Almost never, right? We get excited when things are expensive. That's completely backwards from how we shop for literally everything else. Nobody sprints to the store because prices doubled, but in markets, a higher price makes the crowd want it more. The second killer is fear of missing out, and a bull market is basically an industrial-scale FOMO machine. Every gain someone else brags about feels like money that was stolen from you. So people abandon their plan. They see a friend post gains on some hot stock or coin, and they throw in savings they can't afford to lose at the worst possible entry point. FOMO is dangerous because it compresses your decision timeline. Good investing is patient and boring. FOMO makes you feel like you have to act right now or be left behind forever. And here's the cruel twist. The louder the crowd gets, the later in the cycle you usually are. Maximum excitement often shows up near maximum risk, not near maximum opportunity. Mistake number 3, leverage. In a rising market, borrowing money to invest feels like a cheat code because gains get amplified and everything you touch seems to work out. Margin, options, leveraged funds, they all magnify returns in both directions. On the way up, that's intoxicating. But leverage doesn't care about your feelings when the direction changes. When a leveraged position moves against you, you can face a margin call, forcing you to sell at the worst moment or get liquidated automatically. The bull market giveth, and leverage taketh away. Fun and slightly terrifying fact. A portfolio that's up 50%, then down 50% doesn't break even. You're actually down 25%. Math is unsentimental like that. That asymmetry is why blowing up hurts so much more than it helps. Recovering from a big loss requires a much bigger gain just to get back to where you started. Mistake number 4 is overtrading. Bull markets make people feel like active geniuses, so they trade constantly, jumping between winners, trying to time every wiggle in the chart. Every trade can carry costs, spreads, fees, and in a taxable account, potential taxes on short-term gains, which are often taxed less favorably than long-term holdings in many jurisdictions. Studies of retail traders have repeatedly found that the most active traders tend to underperform the least active ones. Activity feels productive, but in investing, it's often the enemy of returns. Every time you sell to jump into something hotter, you're making 2 correct predictions: when to get out and when to get back in. Being right twice, repeatedly, is astonishingly hard. Mistake number 5, concentration disguised as conviction. In a boom, one sector or a handful of names lead everything, so people dump their whole net worth into that single winning story. It looks brilliant while the trend holds. But you're taking on huge single stock or single sector risk. And when leadership rotates or the narrative cracks, that concentrated bet can hurt badly. Diversification is often called the only free lunch in investing, because spreading risk across many holdings can reduce your exposure to any single blowup without necessarily sacrificing expected long-term return. But in a euphoric market, diversification feels stupid. Why hold boring stuff that's lagging when this one rocket ship keeps going up? That feeling right there is how portfolios get dangerously lopsided. Let me make this concrete with a worked example. Meet two investors, both with $10,000, both investing during the same booming 3-year stretch where the market roughly doubles. Investor A buys a broad, diversified index fund at the start and does absolutely nothing. No checking, no tweaking, no drama. Just sits on their hands like a bored houseplant. Investor B waits nervously on the sidelines, jumps in only after prices have already surged and headlines turn euphoric, chases the hottest names, and adds a little leverage for good measure. When the inevitable 10 or 15% pullback hits, and bull markets are full of these, Investor A shrugs and keeps holding, while Investor B panics and sells near the bottom. By the end of the same rally, Investor A captured most of the market's gain. Investor B, despite living through an identical bull market, ended up with far less and a lot more stress. These are illustrative numbers, not a promise of any specific result, but the pattern is real and repeatable. Same market, same time frame, wildly different outcomes driven purely by behavior. Now here's a subtle one people miss entirely. The story you tell yourself about a bull market changes how you define winning. You stop comparing yourself to reasonable benchmarks. Instead, you compare yourself to the luckiest, loudest person you know, the one who 10x ED on something absurd. Against that fantasy, a solid, steady return suddenly feels like failure. That envy pushes people to take bigger and bigger risks to catch up, which is exactly when they blow through their real risk tolerance and set themselves up for a devastating loss. Real quick, be honest with yourself. Have you ever felt poor watching someone else get rich, even though your own money was actually doing fine? That feeling costs people fortunes. There's also the recency bias problem. After a couple of great years, your brain quietly assumes the future will look like the recent past, so you extrapolate the good times forever. That's when people start treating temporary conditions as permanent facts, taking on debt, quitting stable income, and sizing bets as if the market owes them another year of easy gains. Markets move in cycles. Nobody rings a bell at the top, and I certainly can't tell you when any particular run ends. But assuming it never ends is where the real danger lives. Add in survivorship bias. You only hear about the winners loudly celebrating online, never the thousands who made the same bet and quietly lost. The sample you see is dangerously skewed. So what actually separates the people who keep their gains from the ones who give them back? It's rarely intelligence or secret information. It's boring, unglamorous behavioral discipline. First, have a written plan before the excitement hits. Decide your asset allocation, how much you'll invest regularly, and what you'll do during a downturn, while you're still calm and rational. Second, consider automating your contributions. Dollar cost averaging, investing a fixed amount on a schedule, removes the emotional guessing game of trying to perfectly time your entries and exits. Third, right-size your risk. Only take positions you can hold through a scary drawdown without being forced to sell. If a 50% dip would wreck you, that position is too big. And a gentle reminder that this is general education, not tailored advice. Your situation, timeline, and risk tolerance are unique, and a qualified professional can help you build a plan that fits. Fourth, rebalance periodically. When your winners grow into a huge chunk of your portfolio, trimming them back to target quietly forces you to sell high and buy the laggards low. Fifth, keep an emergency fund and avoid investing money you'll need soon. Being a forced seller during a dip is how paper losses turn into permanent, real, painful losses. And sixth, mute the noise. The financial media and social feeds are engineered to keep you anxious and reactive because your calm, patient, do-nothing behavior doesn't generate clicks or engagement. The uncomfortable truth is that the optimal strategy for most long-term investors is almost embarrassingly dull. Buy broadly, keep costs low, contribute consistently, and then mostly leave it alone. Let me zoom out. A bull market doesn't make you money. Your behavior inside that bull market decides whether you keep any of it. The rising tide lifts boats, but panic sinks them. The people who lose aren't unlucky. They chase what's already run up. They overleverage. They overtrade. They concentrate. And then they sell in fear the moment the market does something normal. Meanwhile, the quiet, consistent, diversified investor who tunes out the hype usually walks away with the market's return, which, over the long run, has historically been pretty rewarding, though never guaranteed. So the next time everyone around you is euphoric and giving stock tips at dinner, don't ask how much you could make. Ask whether you're following your plan or chasing the crowd. If this reframed how you think about rising markets, do me a favor and hit subscribe. It genuinely helps this chunky little channel keep making finance make sense without the hype. And if you want to go deeper, watch my next video on how bear markets quietly build the biggest fortunes. Because everything we covered today works even harder when prices fall. Until then, stay patient, stay diversified, and remember, the goal isn't to win the bull market. The goal is to still be standing, invested, and calm when the next one begins.